If I asked you right now, right where you are, to just take a guess, estimate the number of pure economic decisions you're going to make before your head hits the pillow tonight, what would you say?
It's a tough one to even think about, isn't it?
It is, because before it's even noon, you've probably already made dozens. You chose your coffee, right?
Yeah.
Was it the home brew or that expensive latte from the cafe?
Did you take a taxi or did you decide to use public transit to save a bit of money? That's another one.
Exactly. Or you open an app, you saw a flash sale. That's a classic. Do you buy now, lock in that price? Or do you wait and you risk the cost going up later?
And those three decisions, which, I mean, they feel completely mundane, totally normal. They're really just the beginning. By the time your day is over, you will have consciously or maybe unconsciously processed well over 100 of these little economic calculations.
But there's a much bigger puzzle underneath all of that, one we see evidence of every single day, but maybe don't think about. Let's talk about salary. If your salary is paid by your company, where does the company's money actually come from?
Right. And that's where the simple answer just doesn't cut it anymore.
It's that moment when you realize the company pays me or, the government transfers my benefits. It stops being a satisfying answer. It's true, of course, on a transactional level.
On a surface level,
Yeah.
yes. But it's dangerously superficial. It is, to borrow a great phrase, just the tip of the iceberg. You see it floating there, but you don't see the massive unseen mechanism underneath.
So that's what we want to get into today.
Absolutely. The company is not some self-generating chest of gold.
Mm.
Your ability to get paid, to afford that taxi, to save for something in the future,
Mm.
it's all generated by this vast, incredibly complex, and sometimes, frankly, chaotic chain of linked decisions.
Made by millions of people all over the world.
Millions. Think about it for a second. Someone in Shenzhen decided to buy a tiny component. That allowed a company in Germany to get a loan from a bank. That loan allowed a manager in your city to invest in a specific piece of technology. And that investment generated the revenue that ultimately becomes your salary.
That entire chain, that intricate global web,
Hmm,
that is the economy.
that's it.
Okay, so let's unpack this. Let's try and provide the clarity that that chain so often hides. Our mission for this deep dive is to define those underlying mysteries that really control the reality of your day-to-day life.
We need to get past the surface effects and down to the deep causes.
Right. We need to answer those core questions that I think haunt every consumer. Like, why did the price of your coffee at the local cafe suddenly jump up, even though you know for a fact the wholesale cost of the coffee beans hasn't changed in 6 months?
Or, and this one's maybe more personally frustrating, why did the bank approve your credit application back in January with a smile and a great rate, only to just deny you flat out in March? And now they're demanding a higher credit score, more collateral.
Hmm.
What changed?
And the big one for employees, the one that causes so much frustration. Why didn't your salary go up this year, even when your company was all over the news, reporting absolutely record profits to its shareholders and paying out massive dividends?
These aren't random events. There are clear answers.
And that's our goal today. We want to move far beyond just looking at the prices, the salaries, the taxi fares, the surface level stuff. We want to deliver the full instruction manual, the schematic, if you will, of that entire mechanism working below the surface.
We're going to connect the dots. We'll link supply chains to currency fluctuations, central bank policy to the price of your labor, and the decisions of global regulators to your retirement savings.
And by the end, you should be able to look at any economic headline, any news story, and know exactly which levers were pulled and why. So to build this schematic, we have to start at the very beginning, the foundational truth of all economics. It's a truth we spend most of our lives, I think, trying to ignore, but it dictates every single decision we make,
And that truth is scarcity.
which is a word people often get wrong.
They do.
Hmm.
We often confuse scarcity with poverty. They are not the same thing at all. Scarcity simply means that our resources, so our money, our time, our energy, even our attention, they are limited. They're finite.
But our desires are not.
Our desires are functionally infinite. The desire for a better life, for better technology, more comfort, more security. That never really hits a saturation point. And this isn't a moral judgment on people for wanting more.
Yeah.
It's just a structural limitation of the world we live in.
And this limitation, this is the key. It applies universally. That's why it's so fundamental.
Absolutely. It applies to you as an individual trying to decide between buying a new television or saving up for a down payment on a house.
But it also applies to a massive multinational corporation. They might be deciding between funding 3 new promising projects or dedicating their entire budget to one single blockbuster research initiative that could change everything. They can't do both.
And crucially, it applies to governments managing taxpayer money. No government on earth, not even the wealthiest, has enough money for every single infrastructure project, every social program, every defense upgrade, and every tax cut that its population might demand.
They can't. They have to prioritize.
They must prioritize.
And that need to prioritize, that forces a compromise. And that compromise is what economists call the trade off. Now, this sounds really simple as a concept, but its true cost is often invisible. And that's where so many people, and frankly, a lot of policymakers, get it wrong.
Precisely. To really understand the economy, we have to understand the true price of that trade-off. And that's not the sticker price, it's what we call the alternative cost, or more commonly, the opportunity cost.
Okay, so define that for us. What is the opportunity cost?
The opportunity cost is the value of the most desirable thing you had to give up to get what you wanted. It's not just the money you spent.
Let's use a quick example to make that concrete.
Yeah.
The source material uses rubles, but the currency doesn't matter. The principle is universal. Let's say you have 1,000 units of currency and 2 hours of free time.
Okay.
You decide to spend 500 of those units and your 2 hours on a trip to the cinema. It's a great movie. You really enjoy it. The opportunity cost is not the 500 units.
No, the 500 units are just the cash cost. The opportunity cost is the value of the alternative you sacrificed. What else could you have done? Maybe you missed the opportunity to buy premium ingredients and cook a wonderful dinner at home. Pleasure you lost from that dinner, part of the opportunity cost.
Or maybe you missed the chance to spend those 2 hours studying for a certification course that would have increased your salary potential down the line.
Exactly. The opportunity cost is the lost value of the abandoned alternative. It's often not even monetary, but it's always quantifiable in terms of the utility or the pleasure or the future earnings you gave up.
That really makes every choice feel much heavier, doesn't it? It's not just a line item on your bank statement, it's a decision about a future you could have had.
And if we scale this up to the level of a government, the weight of that trade-off becomes astronomical. Just look back at the year 2020 and the global response to the pandemic. Governments faced a brutal, immediate trade-off that was almost philosophical in its depth.
They had to choose. They had to choose between immediate economic activity, so preserving jobs, supporting businesses, keeping supply chains flowing.
Or prioritizing public health, imposing severe mandatory lockdowns to prevent the complete and utter collapse of their healthcare infrastructure.
They had to weigh jobs versus lives. It doesn't get more fundamental than that.
That is the essence of a painful trade-off. And the sources we looked at, they detailed the astonishing magnitude of that sacrifice in pure economic terms. The alternative costs of the broad European Union lockdown measures, particularly in the second quarter of 2020, it was estimated at approximately 11% of foregone GDP.
11%. Let that sink in. 11% of all economic activity in the EU just erased.
Erased. And it was done purely for the purpose of buying time for their health systems to cope.
That is a staggering figure. And it wasn't a wasted cost, obviously. It was the price they paid to prevent an even bigger catastrophe. But it really highlights the core dilemma. Politicians, just like individuals, are always choosing. If they had spent that 11% of GDP on, say, education reform, what future opportunities would have been created from that? If they'd spent it on military defense, what security would have been given?
Exactly. And this is where the conversation moves beyond simple choice. It becomes about the values that are embedded in that choice. There are no inherently right or wrong economic choices in a vacuum like this.
There are just conscious choices.
There are only conscious, transparent choices made by understanding exactly what fundamental alternatives you're sacrificing. When a government opts for a short-term fiscal stimulus, say, setting out tax rebates, the opportunity cost might be the long-term infrastructure investment that could have increased productivity for the next 50 years. It's this constant battle between the now and the later.
So, step one in understanding the economy is realizing we are perpetually constrained by scarcity. Every single action we take carries a hidden price tag, the opportunity cost.
That's the problem.
So, if scarcity is the problem, what was humanity's first great solution to it?
The solution was revolutionary in its simplicity, but it was absolutely radical in its implication. Realizing that trying to be self-sufficient is a terrible, inefficient idea, and that focusing intensely on what you do best leads to abundance for everyone. If every individual, every company, and every country only has limited resources, then the key to generating abundance, true secret to overcoming scarcity, was found in the power of specialization.
It's just better to do one thing exceptionally well than to do dozens of things poorly.
That's the core idea.
And this principle isn't just some modern business jargon you'd hear in a meeting. It's the historical root of our entire industrialized, wealthy world. When we talk about specialization, we have to start with the philosophical godfather of the modern economy, Adam Smith. Back in 1776, looking at a simple workshop.
The famous pin factory. It's the perfect case study. Smith observed that a single worker, trying to be totally self-sufficient by performing all 18 of the necessary tasks involved in making a pin.
And what are we talking about here? Drawing the wire, cutting it.
Exactly. Drawing the wire, cutting it, sharpening the point, grinding the top, attaching the tiny head. All of it. A single worker doing all that could barely produce 20 pins in a full day of really arduous labor.
20 pins.
But the moment Smith introduced the division of labor organizing those 18 tasks among just 10 specialized workers, the output exploded.
And what did it explode to?
That team of 10 workers could produce an astonishing 48,000 pins per day.
48,000. That's a 2,400-fold increase in per worker productivity.
A massive leap. And it was just from focusing each person on a very narrow, specific task they could master.
This was the blueprint for the entire Industrial Revolution.
It was. And if you fast forward to the early 20th century, you see Henry Ford taking specialization to the absolute next level with a moving assembly line in 1913. Before Ford, the manual sort of generalized assembly of Model T car could take up to 12 hours.
And Ford, by implementing these hyper-specialized repetitive tasks on a moving line, he slashed that time.
Slashed it down to just an hour and a half per car. This wasn't just a business innovation. It was a fundamental shift in economic efficiency that made the automobile accessible to the average American family for the first time.
And today, specialization is reaching extremes that I think challenge our very understanding of what labor is.
Oh, absolutely. Consider South Korea. It holds the world record for industrial robot density. They employ 1,000 high-tech robots for every 10,000 human workers.
So you'd think unemployment would be through the roof.
You would think, but it remains remarkably low, around 3%. The robots aren't just replacing humans entirely. They're forcing humans to specialize even further, to migrate away from the routine, predictable tasks and toward highly complex, value-added, creative, or strategic roles that a machine can't do.
I think we sometimes forget how deeply embedded this is in our service economies, too. Let's take that basic food delivery analogy we started with.
Perfect example.
The restaurant specializes in cooking a specific type of cuisine. The credit card company specializes in secure payment processing. The software company specializes in writing the optimization algorithm for the delivery routes.
And the courier specializes in rapid, efficient local logistics, not in cooking.
Right. And if that courier suddenly decided he wanted to be self-sufficient, to grow the wheat for the flour, raise the cattle for the beef, develop the software, and then deliver the meal.
That single meal would take months to produce and would cost 1,000 times more than it does right now. It would be impossible.
It's a great thought experiment because it just exposes the fallacy of complete self-sufficiency in our own lives, right? The writer of a deep dive like this doesn't handle the graphic design. The accountant doesn't program the inventory system.
The CEO doesn't process the invoices. We all succeed by intensely narrowing our focus.
But this immense efficiency, it comes with an inevitable and growing cost. And this is where the skeptical view has to come in.
It does.
I want to circle back to that. Doesn't this relentless drive for efficiency, for hyper-specialization, make the entire global economy incredibly vulnerable, incredibly fragile? Is that efficiency always worth the systemic risk it creates?
That is a fascinating and critical paradox. Specialization inevitably, by its very nature, leads to dependence. No single company, no region, no country can do everything by itself anymore.
And this dependence is the very definition of trade.
It is. You exchange the thing you were best at for all the things you need from others. However, when you concentrate that specialized production in a single geographic area, you create a massive supply chain choke point.
And we saw the devastating real-world consequences of this dependency so vividly in the early 2020s. Just think about microchips.
It's a perfect example. Taiwan produces about 60% of the world's most advanced semiconductors.
So when the specialized supply chain for those chips fractured, it could be due to trade tensions, a pandemic, even a localized natural disaster. The ripple effect was catastrophic
Yeah,
and immediate.
it was. Global auto production just throttled down, not because of a lack of steel or rubber or glass, but because of a tiny, highly specialized component that costs a few dollars. Finished cars were just sitting in parking lots for months, completely useless, just waiting for a chip.
So that global reliance on that one specialized production point, it created a massive systemic and geopolitical fragility.
It absolutely did. So specialization is the secret to our abundance, yes. But dependence is the price we pay for that abundance.
And this absolute dependence forces all of us, the specialized farmer, the specialized factory, the specialized nation, forces us to engage in this continuous high-stakes negotiation with everyone else.
And that negotiation engine is what we call the market.
Okay, so we have a world that's now full of specialized goods and services that all need to be exchanged. How do we determine the value? How do we translate the value of, say, an hour of a programmer's time into a specific quantity of bread? or into a specialized machine component from Germany.
That conversion process, the place where buyers and sellers spontaneously meet, that's where the miracle of the market happens.
The market provides the answer to what things are worth by establishing a price.
And it does so organically. This is the key. It happens without any central authority, any government committee dictating the terms. The price is just the real-time compromise between the willingness of the seller to supply something and the willingness of the buyer to demand it.
Let's drill into the mechanics of this spontaneous pricing. I want to use your favorite illustration, the taxi surge example. It's a classic. It's raining heavily on a Friday evening, and suddenly the price in your app jumps 1.5 times. Why?
The fundamental equation just shifts instantly.
Yeah.
The number of people demanding a ride, it surges sharply. Maybe it triples because walking in the rain is miserable.
Right. But the number of cars available, the supply, remains exactly the same, at least for that first minute.
By that first minute, yes. So when demand drastically outstrips supply like that, the price must rise to clear the market, to balance things out.
And that high price is incredibly efficient at solving the imbalance almost immediately. It sends a critical signal to both sides of the transaction.
It does. For consumers, that high price triggers a reduction in demand. Some customers look at that 1.5x surge and they decide, you know what, the walk is suddenly tolerable. Or they'll just wait 5 minutes for the surge to pass. Demand drops a little.
And for the suppliers?
The drivers.
For the suppliers, the high price is a massive incentive signal. Drivers who are maybe planning to finish their shift or were just sitting at home, they see that high tariff potential and they immediately log on. That increases the available supply of cars.
So the genius of this system is that the price stabilizes when the number of available cars and the number of people waiting for a ride start to align. It's self-correcting.
Completely self-correcting. And while modern algorithms can now anticipate this, they might raise the fare the moment their weather radar detects rain, the underlying economic logic is still pure. Price acts as the critical information carrier, and it clears the market with incredible efficiency. Now, let's connect this back to that first mystery we posed at the start. Why did your coffee price rise when the cost of the beans was stable?
Because the price of that cup of coffee is a continuous negotiation based on the cost of all the inputs. And many of those inputs are operating on very different supply and demand curves than the coffee beans themselves.
Right. It's almost never the raw material that drives the final cost fluctuation in a manufactured good or a service. In a cafe, things like labor, rent, utility costs, they are far more significant inputs than the beans.
Exactly. So if the commercial rent market in that neighborhood surges, maybe because demand for prime real estate is what we call inelastic, the cafe has to pass that cost on to you. If local fuel prices rise, their delivery costs go up. If minimum wage mandates increase, their labor costs rise. The beans could be free and the price would still go up.
So we need to understand that every single one of these input costs is subject to its own unique price sensitivity test. This is what economists call elasticity.
Yes. And elasticity just determines how much a consumer's demand for a product changes in response to a change in its price.
This is where we see that crucial difference between what we need and what we want.
It is. If the price of bread or basic heating fuel rises by 50%, you might grumble about it, but you generally have to continue buying it. Your demand barely reacts to the price increase.
That is inelastic demand.
The product is either a necessity or there are no viable substitutes. This is why governments love to tax goods with inelastic demand like gasoline or tobacco, because they know people will pay the higher price regardless.
But conversely, if the price of the newest flagship smartphone goes up by 50%, many consumers will just say, no thanks. They'll postpone their purchase, they'll downgrade to a previous model, or they'll switch to a competitor.
And that's elastic demand. Price is a decisive factor, and the goods are often postponable or they're easily substitutable. And this concept of elasticity is absolutely crucial during times of crisis.
How so?
Well, think about the economic recovery after COVID. That, coupled with major supply disruptions, like the natural gas curtailments in Europe in 2022, it caused world natural gas prices to multiply. They skyrocketed.
But demand remained inelastic. People couldn't just stop heating their homes in the winter.
They couldn't, so they were forced to absorb those higher prices, and that led to massive inflation in their utility bills.
But the luxury market, the high-end jewelry, the premium vacations, the expensive watches, it sees the exact opposite effect.
Demand evaporates almost instantly in a crisis because those purchases are entirely elastic. They can be postponed until confidence and stability return.
So this brings us back to the most personal economic mystery. The labor market. Why didn't my salary rise even when the company was making record profits? This is a classic supply and demand problem.
It is. And the input, your skilled labor, is often elastic relative to the company's output, which is its profit.
Explain that. If your company is reporting record profits, that profit might be driven by automation or successful cost cutting in their supply chains, or maybe they have monopoly pricing power. It's not necessarily driven by the increased productivity of the average employee.
That's the key. And if there is a high supply of specialists available in your field, if there are maybe thousands of people with your exact skill set looking for work,
Mm.
the employer has absolutely zero economic incentive to raise your wage.
So, where does the profit go?
That profit will, by default, be diverted to the providers of capital. It'll be distributed as dividends to shareholders, or it will be reinvested into more automation or expansion. Wages only soar when there's a genuine skills deficit. When the supply of qualified people is truly scarce, that forces employers into a bidding war for talent, and the price of labor, your salary, finally rises.
So, until that scarcity exists in your specific niche, corporate profits and individual salaries can remain completely decoupled.
That's right. It sounds like the market is less of a benevolent provider and more of a relentless negotiating engine that rewards scarcity and punishes abundance.
Price is the result of that continuous impersonal negotiation. It's a compromise.
And to facilitate this global negotiation of all these specialized goods and services, we needed something. A universal value translator that could handle these complex exchanges. We needed money.
Hmm.
Okay, so we've established that specialization is the key to abundance, but that it absolutely demands trade. And trade, in turn, requires a mechanism that's far more sophisticated than just simple bartering.
Right. Without money, the entire specialized economy just collapses. It collapses back into that impossible constraint you mentioned earlier, the double coincidence of wants.
The old programmer's dilemma is the perfect illustration. I, the programmer, need bread. But the baker doesn't need my website. He needs a haircut.
Mm.
The hairdresser, meanwhile, needs milk. I would spend my entire life just searching for this perfect, complex chain of trades to get a single loaf of bread.
It's completely inefficient, impossible to scale up to a global economy.
So the solution, and it might be the greatest economic invention of all time, was the implementation of money. And money performs three indispensable functions that allow us to live in a modern, specialized society.
Okay, let's break them down. The first function is the one we all use every single day: money as a medium of exchange.
It allows us to separate the act of selling from the act of buying. I sell my specialized labor for money, and then later, I can use that money to buy whatever specialized goods I need: bread, haircuts, clothes, software. It eliminates that need for a mutual desire at the same moment in time.
The second function is maybe the most profound when you think about it in terms of economic analysis: money as a measure of value.
Yes, it provides a universal language to compare things that are fundamentally unlike each other. If an hour of highly specialized programming is worth, say, 2,000 units of currency, and a kilogram of premium coffee beans cost 100 units.
Then that hour of work is directly comparable to 20 kilograms of coffee beans. It allows us to compare apples and oranges on a global scale. And the third function is the one that gives us our future security: money as a store of wealth.
By saving money, you are transferring your current purchasing power into the future. That's what enables retirement, or saving for large purchases, or making investments.
But this third function is the Achilles heel of the whole monetary.
It is. Because for money to be a reliable store of wealth, it has to retain its value over time. If the value erodes, then the entire function of planning for the future completely fails. And the primary destroyer of money's value is inflation.
Inflation, that general sustained rise in the price level of goods and services, it means that the purchasing power of your unit of currency diminishes over time.
Right. If you have 10% inflation, that 200 unit coffee we talked about now costs 220 units.
Mhm.
Your nominal savings haven't changed, but your real purchasing power has just dropped by it.
This is why inflation is so often called a hidden tax, right? It particularly hurts those on fixed incomes or people who just have their money sitting and saving.
It creates what economists call monetary illusion. People feel richer because the number on their payslip looks bigger, but they're actually poorer because prices have risen faster than their wages.
And when inflation gets really extreme, say at 90%, like we saw in Turkey in 2022, or when it spirals into hyperinflation, people just lose all faith in the currency.
They do. They start hoarding real assets instead, things they can touch. And the economy can actually devolve back toward a state of bartering. It's incredibly destructive.
So how do we track this loss of value in a way that's scientifically rigorous? We relied on statistical methods, mainly monitoring the cost of a fixed basket of goods and services that an average representative household buys. This is the Consumer Price Index, the CPR.
And the composition of that basket,
Yeah.
it is politically and economically charged because it determines how inflation is felt and perceived by the public.
In the United States, for example, housing and shelter costs typically make up about a third of the total CPI basket. Transportation is around 16%, and food is about 4%.
But if we look at developing economies, and this speaks to the context of some of the source material, which often focuses on markets where food costs are much higher, like Russia or parts of Asia, the structure is dramatically different.
Food, for example, often carries a weight that's closer to 30%, and utilities are also disproportionately weighted.
And what that means is that in those developing economies, inflation is felt far more acutely and far more immediately through the basic necessities, the things you simply cannot postpone or substitute, like bread and heating.
So if food inflation is running at 15%, it immediately impacts half the population's budget in a way that 15% inflation on new car prices just wouldn't.
Exactly. And we saw massive inflation globally in 2022. The US hit 9%, Germany reached 10.5%. Even in highly stable economies, that kind of price pressure creates massive social and political strain.
Now let's consider the opposite problem,
Huh.
deflation, the continuous falling of prices. On the surface, that sounds great. Who wouldn't want cheaper goods?
And yet, central banks fear deflation far, far more than they fear moderate inflation.
Why the panic? I mean, if my television is going to be 5% cheaper next month, why on earth would I buy it today?
You wouldn't, and that's the problem.
Mhm.
Deflation creates an immediate pervasive incentive for consumers and for businesses to postpone all non-essential purchases. You wait for the inevitable lower price tomorrow.
And this delay causes demand to just collapse across the board.
Completely. Companies stop investing, they halt hiring, they cut production, and the economy spirals into stagnation. This was the defining characteristic of the Great Depression, where people just waited for prices to fall further and the entire economic machine just ground to a halt.
So the goal is neither massive inflation nor deflation, it's stability, which is why the world's most sophisticated central banks, the US Federal Reserve, the European Central Bank, they target a very precise low level of inflation, typically around 2% annually.
2% is seen as the optimal sweet spot. It's low enough to prevent a catastrophic erosion of your savings, thereby preserving money's function as a store of wealth.
But it's also high enough to incentivize continued spending and investment now rather than delaying. It keeps the economic engine turning over.
Right. And in developing economies like Russia's target of 4%, the number is typically a bit higher. And that just reflects a recognition of the inherent volatility and the specific market structures, like that higher weighting of food we talked about, that demand a slightly larger budget.
So, money is a universal translator, but keeping its value stable is this continuous, high stakes political and economic.
Okay, so if money is the universal language of the economy, then the banking system is its circulatory system. It's the specialized network that ensures the money flows where it's needed most. Most people misunderstand a really fundamental truth about banks.
This is where we need to dispel the money chest illusion, right? People think a bank is just a big vault that stores cash.
Exactly. But in the modern fractional reserve system, banks are the primary creators of money, and they do it through the mechanism of credit.
It's not magic, it's a systematic process. This is the money multiplier effect you mentioned.
It is. Let's walk through a highly simplified example. You deposit 100,000 units of currency into your bank account. The bank is required by the central bank to hold a specific small fraction of that. That's called the reserve requirement. Let's say it's 10%, so they had to keep 10,000 units.
So the bank is then free to loan out the remaining 90,000 units to, say, a business owner who wants to buy a specialized new machine.
Right. That business owner then spends the 90,000 units, and the machine supplier deposits the cash into their bank account. Let's call it Bank B.
And then Bank B has to keep 10% of that 90,000, which is 9,000 units, and it can loan out the remaining 81,000.
And the process just repeats. Your initial 100,000 deposit can, through this cycle of lending and redepositing, generate nearly 1 million units of credit spread throughout the economy. It massively increases the total money supply far beyond the initial physical cash that was printed.
So commercial banks are essential. They connect those who have a surplus of cash savers with those who have profitable ideas but lack the capital borrowers.
And in doing so, they determine the price of money. That's the interest rate they charge on loans, which has to account for risk, for the duration of the loan, and for their own cost of borrowing.
But what determines the baseline cost of money for the entire system? That is the exclusive domain of the central bank.
The central bank, or the CB, sets the key rate, sometimes called the policy rate. This is the interest rate at which commercial banks borrow money overnight from the state or from each other. This single rate is the bedrock. It's the gravitational pull that influences every other interest rate in the economy, from your mortgage to corporate bonds.
And we are seeing these key rates at levels that are significantly higher than they were just a few years ago. The US Federal Reserve rate is around 5%, the Eurozone is approximately 2%, and reflecting high inflationary pressures and local volatility, Russia's key rate is around 17%.
And the CB uses this single tool, the key rate, as its primary instrument for conducting monetary policy. It's basically the thermostat for the entire economy.
How does that thermostat work? Let's say the CB sees inflation running hot, and it's threatening to destroy that store of wealth function of money. They need to cool the economy down.
So they raise the key rate.
What happens then?
When they raise the key rate, the cost of borrowing immediately increases for all commercial banks. Those banks, in turn, must raise the rates they charge you for your mortgage and for business loans. They also tighten their lending standards.
So credit becomes more expensive and harder to get.
Exactly. Companies and people borrow less, they spend less, and they delay major investments. This fall in demand slows down price increases, and that curbs inflation.
And this is the direct answer to that mystery about the denied loan. Why was credit approved in January but denied flat out in March?
It wasn't personal. Between those 2 months, the central bank likely raised its key rate by a significant margin. The commercial bank's cost of capital went up, their tolerance for risk decreased, and so they immediately tightened the standards for lending money to what they might see as marginal customers. The decision wasn't about your personal finance. It was about a systemic monetary tightening.
And conversely, if the central bank sees economic contraction or the risks of deflation, they do the opposite. They lower the key rate.
Right. Credit cheapens, making borrowing more attractive. This encourages spending, investment, and hiring, and that warms up the economy and prevents stagnation.
Now, we have to discuss the financial phenomenon that acts as one of the most reliable predictors of future central bank action and of recessions in general. That's the inverted yield curve.
Yes. This requires us to understand how large institutional investors think about the future.
So the yield curve, just to define it, plots the interest rates or the yields of government bonds based on how long their maturity is. Typically, a 10-year bond yields more interest than a 2-year bond.
That's the normal curve. It makes sense. Locking your money up for a longer period of time is riskier, so you deserve a higher compensation for that risk.
But an inversion happens when the yield on short-term bonds, like the 2-year, actually surpasses the yield on long-term bonds, like the 10-year. And that just seems completely backward. Why would sophisticated investors accept a lower return for 10 years than they would for just 2?
The answer is their collective bet on what the central bank is going to do in the future.
They think the CB has raised rates very high right now, let's say to 5%, to fight the current inflation.
But these large investors, pension funds,
Hmm.
hedge funds, they're looking ahead and they're predicting that these high rates are going to cause such a severe economic slowdown or a recession that the CB will be forced to cut rates drastically in 2 or 3 years, maybe all the way down to 2%.
So they quickly lock in a guaranteed long-term rate now, say 4% on a 10-year bond, because they are certain that within a few years, new interest rates will be dramatically lower.
They're willing to sacrifice a little bit of short-term gain for long-term certainty because they're anticipating a recession that will mandate those rate cuts. The market is effectively pricing in an inevitable future slowdown. And the predictive track record of this signal is frighteningly accurate. It is. In the US, the inverted yield curve has preceded 9 out of the last 10 recessions over the past 60 years. It is the clearest warning sign the financial markets could possibly issue.
And what's the state of the curve now?
Well, the critical thing is that the curve has been inverted for over a year now. It's sending a very strong, consistent signal that the major financial players are anticipating a significant economic contraction sometime soon. And for commercial banks, that signal means they should immediately start tightening their lending standards and preparing for potential loan defaults, which further chokes the money supply even before a recession officially begins.
So, the circulation of money, facilitated by banks and controlled by the central bank, really sets the financial rhythm of an economy. But none of this works without a structure, without the rules of the game. And that's established by the government.
The state's role is far more pervasive than just policing the financial system. The government has 2 critical economic functions that define its fiscal policy: generating revenue, which it does primarily through collecting taxes, and then distributing that revenue through spending.
And these two actions provide the essential foundation upon which our whole specialized trading economy operates. Every time you buy goods, a portion of that goes to the government as a sales tax or a VAT. Every time you get paid, income tax is deducted.
And this pool of capital then funds the public good: salaries for teachers and civil servants, infrastructure like roads, bridges, and utilities, national defense, and the legal framework that guarantees property rights. The market can only really flourish on a foundation of stable, state-provided infrastructure.
What's particularly fascinating, though, is how the government's budget is structured to act as an automatic shock absorber for economic downturn. This feature is known as automatic stabilizer.
I think people often forget this. Government spending and revenue are cyclically linked. And that creates this powerful counter-cyclical effect.
So how exactly do these stabilizers work during a recession?
Okay, when a recession hits, the economy contracts. Tax revenue instantly falls. Why? Because fewer people are employed, which means less income tax is collected. Corporate profits decline, which means less corporate taxes paid. The government automatically pulls less money out of the system.
And at the same time, government spending automatically rises.
Precisely. More citizens become eligible for unemployment benefits, for welfare programs, and for other kinds of social support.
Yeah.
So the government automatically injects more money into the system just when private demand is at its weakest.
It's countercyclical stabilization. It stops the economy from spiraling into a total collapse by supporting consumer demand during its darkest hour.
The 2008 U.S. crisis is a perfect example of this. The budget deficit ballooned from about 3% to nearly 10% of GDP. And roughly half of that entire increase was entirely due to these stabilizers just working as they were designed to.
Now, when government spends more than it collects in taxes, it has to borrow the difference, and that creates public debt. We hear these staggering numbers all the time. The US debt is 121% of its GDP, Japan's is 260%. Why is this permissible for some nations, but it's catastrophic for others?
The sustainability of that debt depends almost entirely on one thing: trust. The government borrows by issuing bonds, which are basically just promises to repay investors with interest. If investors, global funds, foreign governments, domestic banks, if they trust the country's stability and its ability to tax and regulate, they will continue to buy those bonds at low, reasonable interest rates.
But if that trust collapses, maybe due to political instability or concerns about a default,
Then investors demand exponentially higher interest rates to compensate for the extreme risk. Servicing that skyrocketing interest expense can quickly consume the entire national budget, and that leads to systemic fiscal crises, as we've seen repeatedly in nations where trust is eroded, like Turkey or Argentina.
to measure the health and the size of this national economic foundation, we use the primary metric, gross domestic product or GDP.
GDP is the total market value of all final goods and services produced within a country's borders during a specific period, usually a year. It measures everything from the cost of the coffee you buy to the production value of a specialized jet engine.
And based on the nominal GDP rankings, the US leads at around $26 trillion. It's followed by China at $19 trillion and then Japan at $4 trillion. But the sources we looked at highlight a really critical nuance that challenges those surface rankings, and that's the purchasing power parity or PPP adjustment.
Right. Nominal GDP just uses the current exchange rate to convert everything to dollars. PPP adjusts for the fact that goods and services are significantly cheaper in some economies than they are in others.
So a haircut in Beijing costs a lot less than a haircut in New York.
Exactly. And when you factor in the actual purchasing power of, say, the Chinese unit of currency versus the US dollar, China's economy, by this PPP metric, is actually considered larger than the US economy. This measure is often viewed as a more accurate reflection of an economy's true output and standard of living.
And since we're all specialized and interdependent, the moment we start talking about national GDP, we have to talk about the global stage. This brings us back to the global house analogy we discussed earlier.
National economies are like apartments in a vast interconnected housing complex. Each apartment has its own unique rules, its fiscal policy, its central bank rates, but they all share common essential infrastructure: the electrical grid, the water pipes, and the communal elevator, which is global trade.
So if the pipes burst in one apartment, the entire floor is affected.
Exactly. We saw how that interconnectedness created fragility with Taiwan and microchips. But the ultimate symbol of this global interdependency is the continued dominance of the US dollar.
Countries meticulously track their balance of payments, the flow of goods, services, and capital. Germany and China often run surpluses, meaning they export more than they import. The US, on the other hand, runs persistent trade deficits. It imports more than it exports.
And that structural deficit is actually crucial to the dollar's power,
Why is that?
because the dollar is the world's primary reserve currency. Almost all major global commodities, oil, gold, key technology components, are priced in dollars, regardless of where they are produced or consumed.
And this grants the US what Valéry Giscard d'Estaing famously called the exorbitant privilege.
It does. The US buys tangible goods and services from the rest of the world, and it pays for them with dollars, which are essentially paper IOUs. Other countries then hold these dollars as reserves to facilitate their own trade, or critically, they reinvest them back into US assets, particularly US Treasury bonds.
So the US receives tangible goods, and the world holds debt issued by the US.
But it's universally accepted because of the fundamental trust in the size, the stability, and the liquidity of the American economy.
But if that trust fails, or if a global shock hits, that interconnected spiderweb ensures that the shock spreads immediately.
Think about 2008. A local housing and subprime loan crisis in the U.S. financial market rapidly metastasized into a global financial storm. Why? Because banks in London and Berlin were holding vast amounts of this complex U.S.-linked debt. The tightness of the global financial web ensured that a localized failure became a global catastrophe within months. It just demonstrated that in the modern economy, you cannot isolate problems anymore. Hashtag tag 7, economic cycles and the forces shaping the future. Okay, so now that we've mapped the entire mechanism from scarcity to specialization, price formation, the money supply, and the role of the state, we have to acknowledge that this machine does not run smoothly. Economic growth is not a straight line. It moves in waves. This is the natural rhythm we call economic cycles.
And these cycles are usually categorized into four distinct phases. Expansion, which is growth up to a peak.
Then contraction, the downturn, which is often a recession or a slump.
Then the trough, which is the bottoming out of the cycle.
And finally, recovery, the ascent back toward another expansion.
And contrary to what some people might believe, these cycles are driven less by macro algorithms and complex models and more by the collective psychology and sentiment of millions of.
That's absolutely right. When there's widespread optimism, consumers feel confident, so they spend. Companies see that demand, so they hire and invest. Asset prices surge. But then a trigger event occurs. A financial bubble bursts, or maybe the central bank raises interest rates too sharply, and that optimism just evaporates. Fear takes over.
And when fear reigns, the whole process reverses. People prioritize saving over spending. Companies delay expansion and start laying people off. Demand contracts, and the economy slides into a recession.
And during that contraction, we see predictable signals. Unemployment rises. In the U.S. early 2000s recession, for example, joblessness jumped from 4% to 6.5%. Because demand is so low, inflation usually slows down or even falls.
But the cycle is inherently self-correcting, isn't it?
It is. When the trough is finally reached, assets are cheap, labor is abundant. This creates very attractive investment opportunities for risk takers. Demand eventually recovers, businesses resume hiring, and the economy begins its slow, grinding ascent toward the next expansion phase.
On average, a full cycle lasts between 6 and 10 years, but history shows massive variations.
Huge variations.
So given that we are perpetually riding this wave, how do we predict where we are in the cycle? What are the most reliable signals we can look for beyond that inverted yield curve we already discussed?
We look at what are called forward-looking indicators. One of the major signals is the Business Activity Index. If this index, which measures manufacturing and service sector sentiment, falls below the 50-point threshold for several consecutive months, it signals that businesses are bracing for contraction. That makes a recession highly likely.
We can also monitor the weekly unemployment claims. If the number of people filing for first-time unemployment benefits rises consistently for several weeks, it shows that companies are actively cutting staff. The labor market is weakening, signaling the onset of a contraction.
And critically, consumer confidence indices. If people are feeling pessimistic about their financial future, they will cut their spending on those elastic goods we talk about and start saving cash instead. And since consumer spending is the largest component of GDP in most developed nations, falling confidence is a very powerful predictor of a future economic slowdown.
What feels particularly alarming today, as opposed to previous cycles, is the acceleration factor, and that's driven primarily by globalization and these hyper-specialized supply chains.
The spread of economic shocks is now measured in days, not years. Just think of the 1973 oil crisis. It took a full 2 years for that OPEC-driven price hike to fully translate into a global recession.
And compare that to the 2021 Suez Canal blockage. A single container ship specialized in maritime logistics blocking the world's most specialized shipping lane for just 6 days.
And it cost global trade $9 billion daily. The impact was felt on store shelves almost instantly. This rapid propagation means that adaptability is now paramount.
So let's conclude by looking forward. What are the three non-cyclical defining structural forces that are fundamentally reshaping the global economic map, pushing it toward that faster, more volatile future you mentioned?
First and foremost is technology. We are beyond the internet revolution now, and we're into the AI and advanced computing era. The competition for leadership in AI and chip development, the foundational components of the next economy, is a zero-sum geopolitical struggle between countries like the US, China, and key specialized players like Taiwan. Economic advantage will increasingly go to those nations that control the technology itself.
And this requires a corresponding specialized human capital, right? The sources make it clear. Possessing the best chips in the world means nothing if a country doesn't have the educated workforce, the programmers, the engineers, the ethicists who are capable of capitalizing on them. The human element is still the final constraint.
The second defining force is climate. Climate risk is no longer external to corporate finance. It's an integrated economic liability. We're talking about two types of risk here. Physical risk, which is the damage from extreme weather events that can annually consume 1% to 2% of GDP in vulnerable economies.
And transition risk, the cost of moving away from fossil fuels.
Exactly. And this transition risk is driving massive capital flows. In 2022, global investment in renewables reached $500 billion. It actually surpassed the investment dedicated to oil and gas extraction for the first time. Climate change has become this powerful economic force, creating huge corporate losses on one side and unprecedented investment opportunities on the other.
And the third force.
The third, slow moving but ultimately unavoidable force is demographic. The global balance of working populations versus retired populations is shifting dramatically, particularly in developed nations and some large developing ones.
You just have to look at China. Their population declined for the first time in 2022. By 2030, over 16% of their massive population will be 65 or older.
And this aging trend, which is replicated across Europe and Japan, raises these profound questions about the solvency of pension systems, the source of future tax revenues, and the decline in the working age tax base. Who is going to pay for the vast retired population?
And you contrast this aging challenge with the demographic explosion that's happening in Africa.
It's a completely different story. By 2050, it's estimated that 1 in every 4 people on Earth will live in Africa, creating a massive youth boom. This shift means the global center of consumption and labor is migrating, generating vast new consumer markets, but also demanding huge capital investment in infrastructure and education to handle that influx.
So, the ultimate conclusion for our listener is that the economy of the future will be defined by its speed and its flexibility. Crises will be sharper, they'll be more immediate and systemic, but the potential for rapid recovery and technological adaptation will also be greater.
We can no longer afford to seek stability above all else. I think the most important skill for navigating the coming decades, whether you're an individual or a policymaker, is going to be adaptability in the face of constant, accelerating change. Hashtag tag outro.
We started with a simple decision about your morning coffee, the absolute surface level of economic life. And we have now connected that one daily transaction to global trade deficits, the central bank's interest rate policy, the inverted yield curve, and the aging populations of massive industrial powers.
What hopefully emerges from all this is a clear schematic. The price of your coffee is influenced by the commercial bank's cost of money, which is set by the central bank to manage inflation, which in turn is monitored globally via signals like that yield curve. Your mortgage, your job security, your savings, they are all woven into this global economic fabric of GDP, money supply, and highly specialized value chains.
So the next time you read a headline about inflation or interest rate hikes or a supply chain disruption in some far off country, it shouldn't feel like a random abstract event anymore. You now have the underlying logic.
And despite the staggering speed of technology and the complexity of global finance, the fundamental principles remain fixed. Resources are scarce, and every choice involves a trade-off. People will always specialize to create abundance, and the economy will forever cycle through the human emotions of optimism. So, as you go about your day with this new understanding, we want to leave you with one final provocative thought that really ties this entire system together. Now you see the full schematic. What element seems to you to be the most crucial, the most powerful driver of the entire global system? Is it the sheer raw power of money, that universal value translator that links every single specialized decision on the planet? Is it the relentless accelerating force of technology, the artificial intelligence and the microchips that are constantly rewriting the rules of productivity and speed?
Or is it simply the millions of individual, conscious, and emotional human decisions, the collective optimism and fear that ultimately create the cycles of boom and bust and define the economic direction of the entire world?
Think about how this knowledge changes the way you navigate the financial news starting tomorrow.